Financial statement analysis. What is financial analysis? What are the components of financial statements? Why do we need to carry out financial statement analysis? Who are the parties interested in financial statement analysis? Let me quickly say that the topic we are looking at tonight is a topic we can relate with easily. First, what is financial statement analysis? Financial statement analysis, or precisely financial analysis, is the evaluation of a firm's past financial performance. Financial analysis is the evaluation of a firm past financial performance and its prospects for the future. Let's expand that. If you are doing financial analysis, there are two things you are trying to achieve. One, you are trying to look at, excuse me, please, the financial performance, the past financial performance of a business entity. Then secondly, you are trying to evaluate a company's future financial prospects. Financial analysis involves analysis of the firm's financial statements and the cash flow statements. Financial analysis involves the analysis of a firm's financial statement. What are the components of financial statements? The income statements, the statement of financial position, the cash flow statements. This analysis involves calculation of various ratios. If you are conducting financial analysis, this involves calculation of various financial ratios so as to determine the firm's past financial performance and its future financial prospects. Who are the parties interested in financial analysis? We have the creditors, like banks. If a company is planning to obtain loan from the bank, if a company is planning to obtain loan from the bank will request for the company's financial statements. The bank will now subject that financial statement to financial analysis. Just 1 minute, please. Bank will now subject that financial statement to financial analysis. Bank is a creditor. The investors will also be interested in financial analysis. If you want to invest in company shares, definitely want to have some assurance that if you place your investment with a company, that company will give you adequate return, and there's guarantee that the company will safeguard your investments. You can now subject that company statement to financial analysis. We have companies managers. Government is also interested in company financial analysis. So, in summary, financial analysis is the evaluation of a firm's past financial performance and its prospects for the future. What is a financial statement? Financial statement of an enterprise presents the summarized data of its assets, liabilities, and equities in the balance sheets. The financial statement of an enterprise presents the summarized data of its assets, liabilities, and equities in the statement of financial position, and its revenue and expenses in the income statement. If these statements or if this data is not subjected to analysis, one may draw a wrong conclusion. One may draw an erroneous conclusion about the firm's financial condition. If you take a company financial statement, you have the income statement. The income statement will show the revenue and expenses. You have the statement of financial position. The statement of financial position will show the assets and liability. Without subjecting these statements to further analysis, it may be difficult to draw a correct conclusion about the company's financial health. Now the question is, how do we carry out financial analysis? The question is, how do we carry out financial analysis? You have what we call horizontal analysis, vertical analysis, and ratio analysis. There are three instruments. There are three instruments that can be used to carry out financial analysis. You have what we call horizontal analysis. Then number two is vertical analysis. Then number three is ratio analysis. Let's look at horizontal analysis. This involves evaluating trend in the accounts over the years. When we say horizontal analysis is used to evaluate trend in the accounts over the years. For example, if you compare profits in year one with profits in year two, profits in year three, what you are doing is called horizontal analysis. Horizontal analysis is used to evaluate trend. I can compare profit of 2020 with the profit of 2021, with the profit of 2022, with the profit of 2023. That is what we call horizontal analysis. You are using the same line item, profits, an item in the income statement, a line item in the income statement. You now compare for a number of years. That is horizontal analysis. If you look at a typical company financial statement, you have what we call comparative financial statement. That comparative financial statement is an horizontal analysis. You are comparing financial figure, 1 year financial figure with another year financial figure. Number two, you have what we call vertical analysis. In vertical analysis, a significant item on a financial statement is used as a base value, and other items on the financial statement are compared to this value. In vertical analysis, a significant item on a financial statement is used as a base value, and all other items on the financial statement are compared to that base value. For example, in performing vertical analysis for the balance sheet, if you want to perform vertical analysis for the balance sheet, the total assets may be selected as the base value. The total assets may be selected as its base value. Each item, each asset account is now expressed as a percentage of total assets. Each asset account is expressed as a percentage of total assets. For example, I can say inventory assets, so total assets. Inventory is an asset. I will now say inventory assets is expressed as a percentage of total assets. I'm trying to measure the proportion of inventory in the company's total assets. That is what we call vertical analysis. A significant item is selected. I can now say, look at it, for example, I can say inventory assets divided by total assets. If I do like this, I can now say multiply by 100/1. vertical analysis. A significant item is used as a base value. The total asset is the base value. All other assets are compared to the total assets. Inventory assets as a percentage of total assets. What I'm trying to measure is what is the proportion of inventory in the company's total assets. I can also say cash assets as a percentage of total assets. I can say cash assets over total assets. Multiplied by 100/1. This is what we call vertical analysis, where you select a significant item in the financial statement. You now compare all other items to that particular asset, to that particular item you have selected. That is called vertical analysis. Then we have ratio analysis. We can use ratio analysis to carry out financial analysis. If you look at horizontal and vertical analysis, vertical analysis compare one figure to another figure within the same category. If I'm comparing inventory assets over total assets, both items are within the same category, assets. If I compare profits in year 1 with profits in year 2, both items are within the same category. It is also important to compare figures from different categories. This can be accomplished using ratio analysis. There are many ratios that analysts can use, depending on what the analyst consider important or what the analyst is trying to achieve. Let us look at these ratios, financial ratios. We have liquidity ratios. You know, I said we are familiar with this, but we now need to understand how to use it for financial evaluation. We have activity ratios leverage ratios, profitability ratios, and market value ratios. But please, we are going to discuss four of them under ICAM study pack: liquidity ratios and activity ratios were combined as one. But let's go to it. What is liquidity ratio? What does liquidity ratio try to measure? What is liquidity? Liquidity is a company's ability. Liquidity measures the ability of a company to meet its obligation, to meet its short-term obligation as it matures. Liquidity measures the ability of the company to meet its maturing short-term obligation. The ability of a company to meet its obligation as at when due is what liquidity ratios try to measure. Of course, company must maintain some level of liquidity. You must maintain some level of liquidity to meet your operational needs. Essentially, liquidity is trying to look at the extent to which company have, the extent to which a company has sufficient cash or cash equivalents to meet its maturing short-term obligations. Where a company has a serious liquidity problem that could lead to insolvency, the creditors will be interested in the liquidity position of a company. If you are trying to give a company loan, you want to know the liquidity of that company. How do we assess companies' liquidity? Mostly we look at the current ratio. Your current ratio, current assets divided by the current liability. The current ratio is used to measure the ability of an enterprise to meet its current liability out of its current assets. You have your current ratio, the current assets divided by current liabilities. Then we have the asset test ratio, the quick ratio. This is used to test, it's a stringent test of liquidity. Largely, under the quick ratio, we exclude inventory. Inventory and prepaid expense are excluded as part of our current assets. If you are to calculate your asset test ratio, you are going to take your cash, your account receivables, marketable securities. You are going to exclude inventory, and you are going to exclude your prepaid item, prepaid expense, divided by the current liability. It is assumed that inventory cannot be converted to cash easily. Number 2 category, we have what we call the leverage ratio. We also call it solvency ratio. Solvency. Solvency is company's ability to meet its long-term obligations as they become due. Solvency measures the ability of a company to meet its long-term obligations. Liquidity measures the ability of a company to meet its short-term financial obligations. While solvency measures the ability of a company to meet its long-term financial obligations as they become due. When we are talking of analysis of solvency, we are looking at the long-term financial structure, the capital structure of a business. We are looking at long-term financial and operating structure of a business. If you are talking of solvency ratios, we are trying to measure the proportion of long-term debt in the company capital structure. We want to look at it, the extent to which a company has obtained debt finance. What are the ratios here? We have debt ratios. Your debt ratio. Your debt ratio compares total liabilities to total assets. Your total debt to total assets. Your debt ratio measures the total debt to the total assets. It shows the percentage of total funds, the percentage of total money obtained from the creditors, the percentage of total money the company has borrowed. Creditors will prefer a low debt ratio. Creditors will prefer a low debt ratio. If a company is taking too much borrowing, there's a risk. We also have debt to equity ratio. The debt to equity ratio is a significant measure of solvency. The debt to equity ratio is a significant measure of solvency. Since a higher degree of debt might make it difficult for the company to meet interest charges. When a company is highly geared, that means you are going to pay interest expense higher. Your repayments higher. That company may be at higher risk of solvency or insolvency. Of course, to calculate your debt to equity ratio, long-term debt divided by its equity form. You can also look at the interest cover ratio. What is interest cover ratio? Your interest cover ratio, also known as time interest earn ratio. Just 1 minute. Let's go on, please. Your interest cover ratio, we are used to that. It's also called times interest earn ratio. The number of times the company's operating profits covers interest expense. The higher the ratio, the better for the company. A decline in this ratio is a cause for concern, calculated as earnings before interest and tax divided by the interest expense. You are trying to measure the solvency of that company. We also have cash coverage ratio. Maybe you are familiar with this or not. I don't know. But please, cash coverage ratio. A problem with interest cover ratio is that it is based on profit before interest and tax. Profit before interest and tax is not really a measure of cash available. Profit before interest and tax does not indicate cash available to pay interest. A more accurate way is to use earnings before interest, taxes, and depreciation. You can compute your cash coverage ratio as earnings before interest, tax, and depreciation divided by the interest expense. We now have profitability ratios. We have explained liquidity ratios, solvency ratios, profitability ratios. Okay, now profitability ratio. No doubt, if you are trying to determine the financial performance of a company, one thing that comes to our mind is to look at that company's profits. Profitability ratio. We provide indication as to the extent to which the company has generated profits, or the company has generated profits. And we can use this to measure the company's performance. All stakeholders are interested in the company's profitability. The company's management, they want to know the profits. The creditors want to know about the profits. The banks, they want to know about the credits, about the profits. Government authority wants to know about companies' profitability. What are the ratios we can use for profitability? You can look at gross profit margin. Your gross profit margin is the gross profit as a percentage of sales value or percentage of revenue. The gross profit as a percentage of revenue. It shows the number of gross, it shows gross profit achieved per 1 naira sales. The gross profit margin shows gross profit achieved per naira sales, calculated as your gross profit over revenue or net sales, multiplied by 100. You can also calculate profit margin. That is the net profit margin. The net profit margin is the ratio of profit after tax to revenue. It indicates the profitability generated from revenue. It indicates the profitability generated from revenue. And it's an important measure of operating performance. Profit margin is an important measure of operating performance. It provides clues to a company's pricing, cost structure, and production efficiency, calculated as your profit after tax divided by revenue as a percentage of revenue. You can also use return on investment, otherwise known as return on capital employed. Return on investment is a key financial ratio. It shows the extent to which earnings are achieved on the capital employed in the business. It shows the extent to which earnings are generated, or it shows the extent to which earnings are returned to the providers of capitals. Basically, there are two ratios that evaluate return on investment. Basically, there are two ratios that evaluate or explain return on investment. One is return on total assets. One is return on total assets. The second is return on shareholders' funds. There are two ratios that evaluate return on investment. We have return on total assets, look at it please. Return on total assets. Your net income divided by average total assets. Let me adjust this. Yeah. Return on total assets is profit after tax over total assets. Something like this was tested last diet. DuPont formula. I will explain that later. I will explain DuPont formula later. Your return on total asset is also explained by two variables. Profit margin multiplied by total asset turnover. How do we compute our profit margin? Please look at it, please. Your return on total assets, net income over average total assets is equal to net income over sales. Your net income over sales is profit margin. Asset turnover is sales over total assets. Please look at this. I can net sales. We strike out net sales. I'm left with net income over total assets. What we are trying to say, and what we mean by DuPont, your DuPont analysis, is that some ratios, there are some ratios that can be used to explain other ratios. If I'm to calculate assets, my return on asset is calculated as net income over total assets. This can be explained by profit margin multiplied by total asset turnover. What this means is that if I'm trying to increase return on total assets, then I must try to increase my profit margin ratio or increase my asset turnover ratio. Let me take that point again. If you want to achieve return on total assets, there are two ratios that explain return on total assets. These ratios are profit margin and total assets turnover. If you want to increase a company return on total assets, then the company should work on its profit margin and or its total asset turnover. That is what we call DuPont. That was number 6 question last diet. Number 7. Examiner says explain what is DuPont analysis. DuPont financial analysis, where it is possible to use two or more ratios to explain a particular ratio. That is DuPont analysis. Look at it, please. As can be seen from this formula, the return on assets can be increased, can be raised by increasing either the profit margin or the asset turnover ratio. You can go on and on. The DuPont formula can therefore be useful to a company by trying to raise its return on total assets. When we say DuPont formula, where it is possible to use two or more ratios to explain a particular ratio, that is DuPont analysis. So please don't forget to calculate return on investment. Your investment is your total assets. The total amount of assets you have invested in a business or investment. Although there could be differences in calculation, examiner will always specify what to use. If you are dealing with return on capital employed, you say operating profit over total capital employed. That is profit before interest and tax over total capital employed is allowed. How you specify your ratio at times depend on what you are trying to achieve. You can also look at return on equity. Return on equity is simply profit after tax over total equity. Earnings available to common shareholders or stockholders. That is what we call profit after tax, divided by shareholders' funds, as a measure of financial performance. Now we have market value ratios. We also call it investors' ratios. Ratios that relate to companies' stock price. Or investors' ratio. One of them is your price earning ratio. Sorry, one of them is earnings per share. Earnings per share. What is earnings per share? Earnings per share indicates the amount of earnings for each ordinary shares in issue. Earnings per share is the amount of earnings, that is, amount of earnings attributable to ordinary shareholders per share. Calculated as your profit after tax minus preference dividend divided. You can multiply by 100. If you are multiplying by 100, that means you are calculating your earnings per share in kobo. You also have price earning ratio. The price earning ratio is equal to the market price of a share divided by the earnings per share. The price earning ratio relates the market price of a share to the earnings generated from those shares. The price earning ratio relates the market price of a share to the earnings generated from those shares. The price earning ratio is an important benchmark when deciding which shares to invest in. The price earning ratio is an important benchmark in determining the company shares to invest in. A high price earning ratio is an indication that the investing public consider the company in good light. A company with high price earning ratio is an indication that the investor have confidence in the company. The company is likely to generate higher earnings at future periods. A low price earning ratio is an indication that investors do not trust the company. The company is not likely to generate higher earnings at future periods, calculated as market price per share over earnings per share. You can use earnings yield. Your earnings yield shows potential return on shareholders' investment. Your earnings yield is a measure of potential return on shareholders' investment, calculated as earnings per share divided by market price per share multiplied by 100. Please note, this is calculated in percentage. It's not too important. You can ignore this. Net asset per share. It's not too. Dividend per share. Your dividend per share shows the amount of gross dividends on every ordinary shares in issue, calculated as gross dividend divided by a number of ordinary shares multiplied by 100. Investors will be interested in earnings per share. Investors will be interested in dividend earnings yield. Investors want to know about price earning ratio, dividend payout ratio. Your dividend payouts shows the percentage of companies' distributable profits that is paid out as dividend to shareholders. Dividends payout ratio. That is the percentage of a company's distributable profits that is paid to shareholders as dividends, calculated as dividend per share divided by earnings per share multiplied by 100. Please, all these things we are saying, you are going to memorize them all. You are going to memorize and be able to internalize them. The way SFM is going now, this ratio will be needed for analysis. It was there May diet. It was repeated last diet. Financial analysis. Your dividend yield. Your dividend yield measures the actual return on shareholders' investment. Dividend yield is a measure of actual return on shareholders' investment, calculated as dividend per share divided by market price per share, multiplied by 100. Your dividend yield is essentially cost of equity. It's your cost of equity. Return, actual return on shareholders' investment. Then lastly, your dividend cover ratio. Your dividend cover ratio measures the number of times ordinary dividend it measures the number of times the ordinary dividend is covered by distributable earnings. That is the number of times companies' distributable profits covers dividend payment. If you compute this ratio, if this ratio is higher, what is the implication of that? If this ratio is low, what is the implication of that? You must try to know it. It's calculated as earnings per share divided by dividend per share. Please don't multiply by 100. It's calculated in times. Finally, DuPont analysis. Although we explained along the line, but let's explain more. DuPont, they separated. DuPont analysis. In the process of interpreting a ratio, an analyst might be interested in a ratio that can be used to explain, or that could be used that could explain that could be explained by a combination of other ratios. When we say DuPont, analysts might be interested in a ratio that could be explained by the combination of other ratios. The DuPont analysis was developed to explain reasons for the DuPont analysis was developed. The date it was developed was not too important. The DuPont analysis was developed to explain reasons for the value or change in value of return on equity. One minute, please. The DuPont model was developed to explain for the value or change in value of return on equity. Thus, the DuPont analysis is a financial value or change in financial value of return on equity. What we are trying to say is the DuPont model was developed to measure, to explain reason for the value of return on equity, or reason why there is change in the value of return on equity. The DuPont analysis model breaks return on equity into its constituent components. Look at it, please. If you are trying to explain return on equity, or you want to know why there is change in the value of return on equity, there are three variables involved. Your return on equity is equal to profit margin multiplied by total asset turnover multiplied by the financial leverage. This is the definition given by DuPont model. Our return on equity is equal to calculated as net income, that is profit after tax, divided by shareholders equity, shareholders funds, is equal to, what is your profit margin? Net income over revenue, that's your sales, multiplied by asset turnover, revenue divided by total assets, multiplied by financial leverage. Your financial leverage is total assets divided by shareholders equity. Now let's divide. Revenue can cut out revenue here. Total assets can cut out total assets. We are left with net income over shareholders funds. Now, what this means is that if you want to know, if you are trying to improve return on shareholders, if you are trying to achieve increase in return on equity, if you want to achieve increase in return on equity, then the company must look at the profit margin, asset turnover ratio, and the financial gearing. Asset turnover and the financial gearing. These three ratios explain return on equity. The DuPont analysis is important in explaining what is driving return on equity. What are the variables that can drive return on equity? One is profit margin. The profit margin shows operating efficiency. Number two is asset turnover ratio. The asset turnover ratio shows the asset utilization efficiency. Number 3 is the leverage factor, the extent of leverage. The extent to which the company has obtained other people's funds. The DuPont model shows that a company can increase its return on equity by maintaining a high profit margin, increasing asset turnover, or leveraging assets more efficient. We are done with the explanation. Please, any question you have? This is by my time I have 9:52. Please allow me like 5-8 minutes. Let me take water and take some rest. By 10 o'clock, we shall start calculation. But if there's any question, you can itemize. Let's discuss it. Any question, please? Please, let's take a break of like 7 minutes. By 10 o'clock, we should be back to this class. Thank you. Okay, let's look at this. Let's look at this. Let's look at this. Let's look at illustration 3. This illustration 3, please. Illustration 3. Yeah, let's look at this question together. Illustration 3. Choice Aluminum PSC in brackets CA is planning to raise 130 million naira new finance for major expansion of its existing business and is considering a rights issue, a placing, or issue of bond. The corporate objective of Choice Aluminum, as stated in its annual reports, are to maximize the wealth of its shareholders and to achieve continuous growth in earnings per share. Look at that word. The corporate objectives of Choice Aluminum PSC, as stated in its annual report, are 1, maximize the wealth of shareholders. 2, to achieve continuous growth in earnings per share. Please note the 2. Recent financial information on Choice Aluminum as follows. You are giving financial information from 2014 2015, 2016, and 2017. The turnover is given to us in Naira. Earnings before interest and tax in Naira, million. Profit after tax given to us. Dividends given to us in Naira. Ordinary share capital, Naira amount in million, at 1 Naira per share. Reserves, we are giving the reserves. You have the company's bond, 8% bond, 20 million Naira. The share price is given to us in Kobo. That is the current share price. The current share price, year 2014, 2015, 2016, and 2017, given to us in Kobo. The par value of the share is 1 Naira. When we say par value, nominal value per share is 1 Naira. The nominal value per share is 1 Naira. The general level of inflation has averaged 4% per year in the period under consideration. The bond of Choice Aluminium are currently trading at their par value at 100 Naira. When we say current price, that is the current market price per bond is 100 Naira. That is the trading price. The value for the business sector of Choice Aluminium as follows. That is the industry average. For the industry that Choice Aluminium belongs to, average return on capital employed, 25%. Average return on shareholders' funds, 20%. Average interest cover ratio, 20 times. Average debt to equity ratio by market value, 50%. Return predicted by the capital asset pricing model, 14%. Note, that asterisk is calculated. Look at the asterisk. Meaning that, just 1 minute. Right, thank you. Let's go on. Just have to change the power source. So examiner says Your return on capital employed is calculated as earnings before interest and tax divided by the closing capital employed. Examiner will try to specify for you. Now look at the requirements. Evaluate the financial performance of Choice Aluminium, comma. Analyze and discuss the extent to which the company has achieved its stated objective of 1, maximizing the wealth of its shareholders. 2, achieving continuous growth in earnings per share. Let me allow my video to press. Now look at that question. The A part of that question is allocated 18 marks. The A part. Examiner allocated 18 marks to the A part. Evaluate the financial performance of Choice Aluminium. Analyze and discuss the extent to which the company has achieved its stated objective of maximizing shareholders' wealth and achieving continuous growth in earnings per share. Now, if I ask the class, or let me put it this way, the examiner didn't tell you to calculate any ratio. Examiner only say evaluate financial performance. In some question, examiner will only ask you to evaluate financial performance like this. In other questions, examiner will tell you the ratios to be calculated. This is an implied question. Examiner is specific about the ratios to be calculated. You now ask yourself, what are the ratios you can compute that can provide indication of this company's performance? What are the ratios you can compute that will tell you about this company, that will tell you if this company has maximized the wealth of the shareholders? What represents wealth to a shareholder? You are dealing with an implied question. Now, what are the ratios we can calculate now that will tell us the performance of Choice Aluminium for the years under consideration? Look at turnover. Look at the company's turnover. What's happening to turnover, please? We can unmute. Please compare turnover. 2014 and 2015. What has happened to the company's revenue turnover? Oh yeah.
It's declining.
Is it declining? In 2014, the company achieved 16.8 million revenue. In 2015, revenue is 19.1.
It's increasing rather.
That means there is growth in turnover. If there is growth in turnover, can we calculate percentage growth in turnover? Let's go to it. Let's go to it. Now we are going to, yes, solution is available, but we are going to show working. We are going to show working on our, we now have to, we have shared two documents. Let us look at please get your writing pad. We are working this together in the class. Please get your writing pad. All right. I have my year. Twenty 17. Twenty 16. 2015. Then I have 2014. Now let's come here. Turnover, growth, in percentage. Now please check. Your 2014, how was the turnover you have? I want to compare 2014 and 2015. Let's go to it. Let me come here. Please, let's compare. I'll take it off later. Oh, I manage this. I can't share three. Okay, let me see how I can manage it. I want to have this line demarcated small. Now, please, your between 2015 and 2014, please check. In 2015, our turnover 19.1 minus turnover in 2014 16.8 divided by 2014 figure 16.8. Please calculate the growth in turnover 2015 and 2014. What do you have, please? Multiply by 100. Oh yeah, oh yeah, oh yeah, oh yeah, oh yeah. Please calculate growth percentage increase in turnover. Oh yeah. Look at my figure. 2014, 16.8. 2015, 19.1. Please compare. What do you have, please?
14% approximately.
Thank you. Please, let's participate in this. We are trying to see how we can. I'll come here. Approximately 14%. Please compare 2016 and 2015. Come here. Between 2016 and 2015, let's compare. In 2016, turnover 24 million minus 2015, 19.1 million divided by 19.1. The answer you get multiplied by 100. What do you have, please?
That's 26%
Approximately, right?
Yes, sir.
26%. The management is trying to see how best to even help. Even though you have the solution there. Where's Prosper? Where's Amaka? This one I like. Amaka, where are you? I'm wondering. 2017 and okay, I'm trying to shorten this. I don't want to go space. I'll go back to it, don't worry. Let me come back here now. and 20 and 2016, our sales figure in 2017, I have 28 million minus 24 million divided by 24 million multiplied by 100. What is the growth in what is the percentage growth in turnover? Yes, please. What is the percentage growth in turnover, please? I think the class is just not ready. The class is not ready for this. Look how we are mentioning here. At the point, the class is just silence. Should we go on with the computation on the?
Yes, sir.
Should we go on? I was
Yes,
asking
sir.
a question and nobody was responding. But
I was logged off.
I was trying to see, instead of just reading the solution, let's show how it was computed. Okay, no problem, we'll try. No, can I do? 28 million minus 24 divided by 24, what do you have? Multiply by 100. What do you have, please?
17%. Approximately.
17%. You have gotten percentage growth in turnover. You can also calculate what we call geometric geometric average growth. When we say geometric average growth, it's simply you are going to add (14% plus 26% plus 17% divided by 3. That's what we call the average of the three ratios you have, 3% you have gotten. Is called geometric average growth. 17 plus 26 plus 14 divided by 3. Look for the average.
That's 19%.
Now place it here. That you have 19%. What you are saying is that on average, turnover grows at 19% annually. We are trying to look for the average. It's okay. On average, this company turnover increase on average at 19% annually. You can also look at, remember we are trying to measure financial performance. What about earnings before interest and tax? Growth. Look at the statement you are giving. Look at this statement, please. Let me look at the first one. Please look at the operating profit. That is profit before interest and tax. What is happening to this profit? In 2014, the profit was 6.8 million. 2015, profit was 7.5 million. 2016, profit was 8.5 million. And 2017, profit was 9.8 million. What is happening to that profit?
It's growing.
Can we calculate percentage growth in profits?
Okay.
Yes, we can calculate percentage growth in profits. Just 1 minute. Let's go to it. I can compare To try and show that working so. What we need to do here is to look at about the space here is small. I can compare in 2015, profit before interest and tax. That was 7.5 minus 6.8 divided by 6.8. What is the percentage growth in profits, operating profits between these 2 years? Check it out, please. Oh, okay. That's the problem. Victor has left. Maybe he's having difficulties. Now I have Fidelis and Believes. Now, please let me, I think what we are trying to achieve, I don't know. It appears the class, some students will step out of the class. By the time they come back, we are trying to have calculation in class. Please compare profit in 2014, profit in 2015. What is the percentage increase in profits? Please compare. In 2014, we have 6.8. 2015, we have 7.5. What is the percentage growth in profits?
10% approximately.
We come here. Under 2014, you have dash. They have 10% approximately. Now check 2015 and 2016. 2015 and 2016. In 2016, profit before interest and tax, 8.5 million. In 2015, 7.5 million. What is the percentage growth in earnings before interest and tax? If you go to that board, it becomes, if I put the work in here now, let me come down here. That becomes 8.5. Oh, let me take this also. That's 13, are we?
Yes, sir. 13%, approximately.
13%. I think that, no, I need to take this off. Doesn't make sense. Take this off deliberately. Okay, I'm better now. I wanted to achieve this. Just slowly. I can, okay, this is 10%. This is 13%. Check 2017 and 2016. Earnings before interest and tax. Compare 9.8 minus 8.5 divided by 8.5. What's the percentage growth in earnings before interest and tax?
15%.
15% under 2015. Under 2017, sorry. Then look for the average. Please add 15 plus 13 plus 10 divided by 3. What is the geometric average growth?
31%.
No, divided by 3.
Okay. Yeah, by 3.
15 plus 13, that's 28. 28 plus 10, that's 13. Divided by 3.
13% approximately.
That's what we call geometric average growth. You place it here. 13%. What you are trying to say is that annually, this company generates 13% growth in operating profit. Profit before interest and tax. That's what you are saying technically. I've calculated two things now. Turnover growth. On average, this company turnover grows by 19%. Earnings before interest and tax grows. On average, this company's earnings grow by 13%. I can also calculate earnings per share. We are trying to determine the extent to which the company has achieved continuous growth in earnings. I can calculate earnings per share. In Kobo. How do we calculate earnings per share? How do we calculate earnings per share?
Profit.
Yes. Profit after tax divided by
number of shares outstanding.
Number of shares outstanding. I can keep this. SFM working one. I can open a new sheet. I have my year. Twenty 2016, 2015, 2014. I want to calculate earnings per share. Yes. Go to the question. Earnings per share. Profit after tax divided by ordinary shares. Now you have this share capital in naira, 1 naira per share. So if I have 5.5 million naira shares, how many shares? 5.5 million naira divided by 1 naira. That means I still have 5.5 million ordinary shares. So please divide. 5.5 divided by 5.5.
1.
That is 1 naira per share. If you multiply by 100, it becomes 100 kobo. So what you are trying to say is that earnings per share in 2017 is 100 kobo per share. Check 2016 earnings per share. Profit after tax 7.7, sorry, 4.7 divided by number of ordinary shares 5.5 million. Multiply by 100. What do you have? $4.7 million divided by 4.5 million shares, multiplied by 100. What do you have, please?
That is 85 kobo.
85 kobo.
Approximately.
Yeah. Check 2015. 4.1 million naira divided by 5.5 million shares, multiplied by 100. What is your earnings per share?
76 kobo. 75 kobo approximately.
$75 kobo. Check 2014. Profit after tax 3.6 million. Number of ordinary shares 5.5 million. Multiply by 100. What is your earnings per share?
65 kobo.
Now, 65. Take it off. $65. Now, please look at it. Look at the trend. In 20, look at the trend, please. In 2014, earnings per share is 65 kobo. In 2015, earnings per share was 75 kobo. This is kobo. In 2016, earnings per share was 85 kobo. In 2017, earnings per share 100 kobo. Is the earnings per share growing or not?
It's growing.
It's growing. Then determine earnings per share growth. Earnings per share growth. Compare 2014 and 2015. That is, you are going to say 7.5 minus, 75 kobo minus 65 kobo. Divided by 65 kobo, multiplied by 100. What is the growth?
15%.
You come here, 15% growth. In 2014, that is your base here. Now compare 2016. Your 2016, 85 kobo minus 75 kobo divided by 75 kobo multiplied by 100. What is the growth?
13%.
Come here. 13% growth. Compare 2017 and 2016. 100 kobo minus 85 kobo divided by 85 kobo. What do you have? Multiply by 100. What do you have, please?
18%.
So we have 18% growth. you can look for the geometric average. 18 plus 13 plus 15 divided by 3. That will give you the,
15%.
what do you have?
15% approximately.
That is what we call geometric average growth. You look for the average. This is 15%. What you are saying is that on average, the earnings grow by 15% annually on average. Also, we can look at dividends, the dividends per share. What is informing the ratio we are selecting? Examiner say we should calculate, we should evaluate company's performance. Can come back in. Dividend per share in cover. To calculate your dividend per share is simply your gross dividends divided by number of shares multiplied by 100. Look at 2017. Dividend is 2.2 million. Number of ordinary shares, 5.5 million. 2.2 million divided by 5.5 multiplied by 100. What do you have, please? $2.2 million. Divided by 5.5 million. Multiplied by 100. What do you have, please?
$40.
That is 40 kobo. Dividend per share in 2014, 40 kobo. Go to 2016. In 2016, our dividend 1.9. Number of ordinary shares 5.5 million. 1.9 million divided by 5.5 multiplied by 100. What do we have? What do you have? That should be 35 kobo. Please check that out. In 2016, dividend per share 35 kobo.
Yes.
Can come back here. 35 kobo. Please check 2015. Dividend per share 1.6 million. Number of ordinary shares 5.5 million. 1.6 million divided by 5.5. Multiply by 100. What do you have?
$29 kobo.
29 kobo. Check 2014. Dividend 1.6 million. Number of ordinary shares 5.5. Also 29 kobo. Let's look at dividend growth. Please look at 2014 and 2015. Dividend per share, is there a growth in dividend per share? Please compare 2014 and 2015. Any growth in dividends? Look at it now.
No growth.
In 2014, no growth now. I can come here and say no growth. %0 growth, no growth. Compare 2016, 35 kobo dividends, and 2015, 29 kobo. What is the growth?
21.
21%. Compare 2017, 40 kobo dividends to 35 kobo dividends. What is the growth?
14%.
Look for the average. 14 plus 21 plus 0 divided by 3. That is called geometric average growth. The average
12%.
12, Abi.
That's right.
Yeah, put it here, average 12%. What you are saying is, on average, this company dividend per share grows at 12% annually. Now let's go back to that because I need to stop the class. Look at it.
Okay.
We have shown calculation up to this place. We have explained turnover percentage growth, geometric average growth 19%, earnings before interest and tax growth, the geometric average growth 13%, earnings per share in kobo, earnings per share growth, geometric average growth, dividend per share in kobo, dividend per share growth, and geometric average growth. We have gotten up to this place today.
Hello?
But we can't continue because of time. We have tried to explain how we have computed these ratios up to this point. Our next class, our analysis we take for a year now. We now round up the question. All right. The whole intent is to see how to improve student understanding on the online class. But I want to believe there will be improvement because responses is quite not encouraging. Any question, please? Otherwise, you call it a good night. Any question? All right, let's have a blessed evening. May God give us a better understanding. Good night.